In our last video lecture in this topic, we're going to be covering material that's in the appendix of the textbook, and this deals with segment reporting. I'm not going to cover it in great detail, but we're going to hit on some of the key basic requirements of GAAP. In a large diversified business, companies often have a strategy to operate in several different types of industries or markets that allow them to achieve growth and also to diversify, which reduces risk. In your strat management classes, you'll be looking at these types of strategies and get a better understanding of how diversification is achieved by working in segments. For our purposes, segment disclosure is important because this allows users to look at different parts of the company. Remember when we talked about the principles of accounting? We said there was only one economic entity. There was only going to be one set of financial statements, regardless of how many subsidiaries a company operated. Well, because of that, the users may not have all the information they need, so GAAP has certain requirements. These are spelled out in topic 280.1050, and the first thing we would need to do is to be able to identify operating segments. And we look to see things like whether we can determine that the segment both earns revenue and incurs expenses. If a segment is there solely to serve the overall corporation, it is not really generating revenues. And that would really be for more internal use, which we'll talk more about in managerial and cost accounting. The other thing we need to have is discrete financial information available. Again, the constraint of the cost benefit. If it would cost more to break out segment information than the benefit the users would derive, a company does not have to break out into every feasible, identifiable operating segment. In the topic, ASC 280.1050, these four items are spelled out as to what has to be disclosed. In addition, you have to report by geographic area. There is a specific requirement at the ASC section displayed on the screen. Let's explain this by looking at a real-world segment report, and this is from Anheuser-Busch. It's a bit dated, going back to 2006, for those of you who are fans of Budweiser, and I know our group, and I think there might be a few. You probably realize that Budweiser a couple of years ago was taken over by a foreign company, IBEV, and they're now a component. But at one point, they were their own corporation, publicly traded, even though it was started and operated by the Bush family. It was a publicly traded corporation. So we see here the different segments that Budweiser presented to their users. You have their domestic beer operation, which includes Budweiser, Michelob. You have international beer sales involving Budweiser and Michelob, and obviously American beer is preferred to the American palate, not so much overseas. Budweiser also provided packaging services for other beverage companies, microbreweries, soft drinks, water companies. And they were able to break out that operation and report it as a segment. And you probably know or may have heard but forgot, but Budweiser also operated an entertainment division. and there's a couple of these parks in Florida, SeaWorld in Orlando, and Busch Gardens in Tampa. There are several other parks around the country, and Budweiser reports that as a separate segment. This last column, corporate and eliminations, is the effect that occurs when one segment does business with another segment. If Budweiser has an American subsidiary who sells to the international market, that intercompany sale is eliminated in the consolidation process to put together one set of financials. This will be a key focus in your advanced accounting class. So not every element of the financial statements is presented, only the ones that the company feels is important for the users to focus on. GAAP also requires, in this code section, that there be disclosures about customers who make up a large portion of our total sales, if in excess of 10%. So if a company is dependent on another company for more than 10% of their revenue, this has to be disclosed. And this is an interesting disclosure from Procter & Gamble, of course, a very large consumer manufacturing company. Well, you can see that Walmart is a key customer of theirs. In the years 2002 to 2004, Walmart and its affiliates accounted for well over 10%, closer to 20% of all sales made by Procter & Gamble. Obviously, if there were to be a falling out between Walmart and Procter & Gamble, this would have a negative impact on the operations and financial position of the company. So Procter & Gamble is required to disclose this to their users. And those are in general terms, are the types of disclosures that have to be made for segment reporting.